Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Localize is a language technology B2B software as a service company, and it's on track to redefine this category. More than 1,800 companies, including MasterCard, Lemonade, Revolut, ABN AMRO, Crypto.com, they all use Localize to manage product translations. On the 13th of May, check out their LinkedIn page and website for more information and details. That's localize.com, LOKALISE.com. And with that, let's start the episode. Horacio, welcome to the podcast.
Thank you very much for having me, Lex.
It's great to have this conversation. I'm really excited. You are the head of digital innovation for capital markets and the head of DLT, the Repo Platform at Broadridge. And I think this will bring to our listeners an interesting and different view about digital transformation, about capital markets, and about the role of blockchain in especially the institutional activity in the financial industry. But before we hop into all that meat, let's start with just your story. How did your career take you towards innovation, and what has your financial services experience been like?
It wasn't the most straightforward path. For the longest time, I started my professional career in investment banking, financial services, equities trading, fixed income, investment banking, M&A. So it was always related to financial services, but never really related to innovation. It wasn't until I joined Broadridge 7 years ago that I started getting very interested about financial technology and innovation that could be applied to financial markets, which is what I know very, very well. And I started way back then in 2016 on Broadridge's blockchain DLT journey, and was very excited by the technology and by the opportunity that we as a firm have to bring change via technology to all the processes and all the products around capital markets. And I joined the corporate strategy group pretty much as a think tank of our innovation and blockchain journey, experimenting with various use cases, experimenting with various technologies, various protocols, pretty much all of them. And then our journey took us to a handful of very, very specific use cases that we saw had the potential to bring significant transformation to the market. And you fast forward to today, one of the key initiatives that we have and we are about to launch in a handful of weeks is our distributed ledger repo platform that we think has the potential to significantly transform market infrastructure.
Slowing us down just a little bit, and even to the basics, right? Because you've had a fairly senior set of roles through the last couple of decades and through the financial crisis. A basic question for you, which is, what is the purpose of financial markets? I mean, you spent time in different parts of it, whether it's investment banking or whether it's capital markets. What do you think is the core purpose, and what interests you about financial markets, especially, I guess, on the institutional side?
On the institutional side, for the most part, is to provide funding and to provide growth. If you think about the fixed income and the equity markets, which is probably the largest ones, right? The key objective is to provide funding to corporations, provide funding to institutions, that funding can be applied for economic growth. So that is the key purpose of the institutional capital markets. So then once you're going into more of the wealth and asset management, it's more of transfer of wealth, transfer of value. But at its core, capital markets is basically to provide and to fuel the growth of the economy. That is the key role that financial markets provide today, in my opinion.
This isn't meant to be a leading question, but I am curious, again, given your various perspectives on this type of activity, has there been any change over the last decade or more, or since the financial crisis, of that purpose? What are the trends that you are seeing underneath that are being reflected in the financial markets? Has there been any change to what you've described?
I don't think there was a change in the purpose of the role of capital markets. It was significantly changed in the way that it was addressed. And by that, I mean much more cautious. So trying to make sure that you ring fence the risks, that there's visibility about counterparty risk, that there is visibility about the transactions that are happening between the various entities to ensure that we don't go back to any crisis as it was 2009. It is not necessarily the role. The role is still the same because it is not a role that is self-imposed. It is a market need. So as long as there is a market need for this funding of fuel of growth, which will always exist, in my opinion, the role is going to stay the same. The way you go about it, that is much different than it was in 2009.
Can you talk a little bit more about what you mean by risk and what types of risk in particular? And this will connect to, of course, DLT, but the ideas of transparency, the ideas of knowing your exposure, the ideas of knowing your counterparty and controlling for that, or finding technology solutions to address that. I guess, what are these core risks that you're talking about to which the financial industry has had to adjust?
I'll explain it with just one example. So it is pretty much understanding the counterparty and unwinding all the activity that a failing firm has with the rest of the market. So when one market fails, a large institution fails, you have to unwind all the activity and you have to understand what are the various fails or defaults that are going to affect other market counterparties. So the understanding and the management of those defaults, of that unwinding of that activity, is critical to make sure that it is an orderly unwind of the failing institutions that doesn't put at risk their counterparties. So that visibility and the orderly unwind of a failing institutions was not there in 2009. It was very opaque. You think about that's where the funding between institutions was very difficult to unwind, and it took several months to understand what the positions of a failing firm was. The visibility that we have today is much better than what we have in 2009, not only because of the regulations and more focus on that visibility, but also technology is going to make even a better difference going forward.
Yeah, and I think, I don't remember the numbers exactly, but the expected kind of liability or impact of the Lehman failure in reality was a lot smaller than the fear that people had about its impact, right? So however long it took, whether it was 5 years or 10 years, and I'm sure there's still consultants generating good fees on running the Lehman estate, to have the data at the moment of the market shock is a huge de-risking of the ecosystem, because you're not imagining things. You actually know what the positions are and you can price them. And if you don't know what they are, then it's just this gigantic mysterious risk, right? That leads people to do a run on the bank in a sense.
I totally agree. Visibility and understanding in real time of the counterparty exposures that any firm has is critical to minimize risk for the entire market, not just for that firm.
Okay, so we get to Broadridge. What is Broadridge?
Broadridge is a financial technology company that provides technology solutions to the overall capital market industry. If you can break down Broadridge very simply in two different large business units, you have number one, investor communications. We manage and provide communications between investors, issuers, intermediaries, for example, around proxy voting. And number two, we provide technology front and back solutions for banks, broker-dealers to execute all their trading activities, from capture trades to processing them and to settling on the back end. Those are the two key large business models that we have and we operate at Broadridge.
And in the role around innovation, what do you focus on?
I focus mostly on the technology solutions to support banks and broker-dealers trading activity. That is where I personally feel that particularly DLT has the potential to change current market infrastructure, reduce friction, and going back to your question before, provide the visibility into the counterparty risk, the exposure between firms that are going to provide even more visibility than we have today. That's what I'm focusing now, mostly. And that is where I view particularly DLT as a great technology to basically improve the processes that are underlying the front to back trading activity that happens at those firms, between those firms.
So I think we'll maybe get into this a little bit later, but one thing worth highlighting up front is, between the two things you've described, the two business units you've described, one of which is proxy voting, there's a lot of analogy to what is happening today in decentralized blockchains, where financial protocols are forming into organizations that require governance. And the holders of various tokens of those protocols are participating in governance voting. And as those systems become larger and larger, they often delegate their voting to entities that can make informed decisions. For me, has always been a really interesting analogy to the system that already exists with proxy voting, where you might hold shares in some fund or ETF and they initiate a vote on your behalf. So in many ways, the sort of technology journey ends up rhyming because it's the same human needs, no matter what decade you're trying to write the software in.
Yes, and we go back to the question around what has changed, right, in the capital markets world, what is going to change. They need to service those assets, to service those equity positions, to provide the ability for institutions and retail investors to exercise their vote. That is going to happen. And the more, the better, right? We're a big proponent of that. So what Broadridge does is provides the technology for people to be able to vote their positions in a very, very efficient way. So as the technology evolves, if digital shares become ubiquitous in the future, the need for voting those shares is still going to exist and still going to be required. And people will want that the processes need to evolve to support a different type of vehicle. But the need for proxy voting and investor communications is always going to be there. And that's what we will always provide, right? The means to make it efficient and easy for investors to vote their positions.
Yeah, and I think this is actually a pretty fantastic blue ocean opportunity still for taking some of these existing tools and frameworks and applying them to the emerging crypto asset world. But that's certainly a different conversation. So switching to the other track, which is the trading systems underlying the capital markets for broker-dealers and banks, can you spend a bit of time on really going through the value chain for how a trade happens, for how a client broker dealer, or maybe is it the trust department of a bank that would want to make a trade and then interface with the software, and then kind of who's downstream from that, who's upstream from that? What does that ecosystem really look like?
It is very complex, and it has a lot of different systems and different parties involved to it. I'll try to simplify it, but still trying to bring the complexity out of it. So you start at the top where the transaction is executed. You have two parties entering into a transaction that agreed on price. It could be on an exchange venue, or it could be over the counter, or it could be on an electronic venue, fixed income or equity. That is where the transaction is agreed and it is accepted by the parties. That transaction then is really captured by the front office systems of each of the counterparties. And at that point, it's basically sent down to the middle office to check that the transaction is right, to go through the compliance reviews, all these different checks and balances for that transaction that had been agreed and had been processed out of the trading venue into the front office and then checked by the middle office systems of the entities.
So that would be, for example, I'm a Goldman trading desk and a Morgan Stanley trading desk. I want to sell a bunch of Apple shares in a block. We're on a phone. We agree on a transaction and we both enter that into our proprietary systems. Is that right?
Correct. So in a very simplified way, yes, you enter that in your system and then it goes through the checks and balances. Is that right? Is that the right amount, the right number of shares, the right price? Who's your counterparty? Has the counterparty been vetted for you to trade with the counterparty? Right. And all those checks happens, you call it a middle office function. Once that transaction is agreed and is checked, then it goes into what we call the back office, which is basically clearing and selling that transaction. Then that transaction needs to be, depending on the asset class, it has to be sold at different venues. It could be sold at DTCC for equities or corporate bonds. It could be sold at other CSDs. And that is where the transaction really sells. The economic interest have been agreed at the top of the transaction. When the ownership change happens, it is at the bottom of this value chain, which is at the CSD or DTCC or Euroclear, whomever the CSD may be. And that is where the settlement happens. And sometimes that settlement, depending on the security, could be T+2, T+3, T+1 from the day that the transaction is sent. Once that reaches that settlement location, then the ownership has happened and the trade has been completed and settled.
So to be sort of cute, let's say that the actual Apple shares are sitting in a CSD and there's a Morgan Stanley sticker on them. And then it takes 2 days for some amount of humans and robots to take off the Morgan Stanley sticker and put on a Goldman Sachs sticker. Or rather, I guess the beneficial owner, whoever was the first beneficial owner. But the actual security is just sitting there, right? You're kind of changing the metadata about that security.
Correct. Yes.
How many software providers are between the start of the transaction and that change in ownership? And what kind of companies are they? And where does Broadridge kind of sit in there?
That is an interesting question. It really depends on the firm. So currently, I would say, let's go through the systems first. So it is basically the front office system. The front office system is where the trader enters the trade and acts on the trade. That is the front office system. That has connectivity to the various venues, and that connectivity, it could be or not a different technology provider. And then you have the middle office systems, which basically aggregate and normalize all the information. That is another layer of technology that you have to apply to that. Then you have the back office systems, which basically provides the books and records for all the transactions that happen across the firm. And then the connectivity within that back office onto the CSDs that has also their own different set of bundle of technologies that connect to the back office and the front office. So that is at a high level, all the packages of systems that exist from the execution of the trade to the settlement of the trade. One thing that the market is going towards is the simplification of front-to-back technologies to create consistency between all those systems. And that is something that Broadridge is doing, trying to simplify the way and the systems that are involved from the capturing of the trade or the execution of the trade to the back office and the settlement of the trade. The more you can not consolidate, but simplify the technology and make it consistent as opposed to having different systems, different vendors, different way of doing things, different standards, the more you can simplify it, the easier it's going to be, and the more efficient it's going to be with less breaks, less reconciliations required for the transactions to flow front to back.
So I assume Broadridge has different point solutions across the different offices and the different counterparties, and then integration makes that more seamless. Can you explain for our listeners what a break is and how it is fixed?
So a break could happen in many ways. And it can happen at various points of the transaction. So a break can happen at the very top of the transaction when both traders or both entities enter the wrong trade or understood the trade in a different way, or the price or the quantity or even the security. So that is the first type of break that can happen. And that's the simplest to fix, because the higher it happens in the front to back flow, the faster you can solve it. And it is changing the economic terms. Obviously, depending on where it happens, the ways to fix it is different, but it could be as simple as updating a ticket, getting the validation from the counterparty that, yes, we have the right trade now. And then both firms have right information on the ticket, and then it's fine for it to flow down forward. That is one example of one trade fail. The other trade fail that could happen is, and this is something somewhat more difficult to solve, I would say difficult to solve, but it requires more effort, is if on the settlement of the trade, let's say on a fixed income securities, that you enter into a trade, but one counterparty cannot deliver the security because they wanted to execute the trade, but they are shorting the security, but they cannot find the security in the market to deliver that security to the counterparty. So that is something that happens fairly often. That's why you have the fails management systems at the clearance firms or the CSDs to make sure that those fails don't happen, or those fails are repaired and the securities are delivered to the counterparty that has to be delivered to.
Got it. I mean, the repairs happen with staff, right? Like with people calling each other and trying to make each other whole, or I guess what does that process look like?
The process, it is fairly manual, and we actually have a group. We take in those operations from a lot of our clients, basically to solve those fails or those reconciliations. Basically, it is very manual and it's very humanly intensive, because you need to make sure that you validate the information. You need to make sure that you understand what is the right trade, what is your counterparty understood the trade was, and then making sure that then you update all the systems accordingly to make sure that that transaction is settled appropriately. So it is highly manual process, particularly reconciliation. It is probably the most where firms spend most of their time, but it's not the largest volume of the transactions. But since there are heavily manual intervened, they take a lot of time and a lot of effort.
So maybe you can see through my trickery, I'm leading you here because it's now the question of blockchain and DLT, and the value proposition, and I think a lot of the narrative and a lot of the commercial logic for blockchain-based systems is very much around some of these pain points that you've described. So maybe we can switch into how you and the firm think about applied blockchain and DLT. I also want to ask about, why it's DLT, why it's not blockchain, why it's, what's the difference between that and a crypto asset, but maybe we get there after understanding how the firm thinks thinks about DLT and what the value is that it delivers?
As it relates to these processes that we just discussed, right, the DLT has the potential to significantly simplify the front-to-back processes required to execute, process, and settle a transaction, particularly with the ability or the features of the technology that allows you to mutualize the workflow around a particular transaction. So the fact that it allows for both counterparties and their agents to actually operate under a single source of truth, basically they both see the same thing at the same time, which is opposite to what I was explaining before. It allows for that sharing of information that in real time, is the same thing that what your counterparty knows. Right? That is number one. That is critical in the possibility of solving very quickly or preventing a lot of these fails and reconciliations. And number two is, as I was saying, it is the mutualized workflow creation. Basically, that you can act on that set of information or you can act on that particular trade or contract that has been entered, and your counterparty knows exactly what action you are trying to create, and then the counterparty can accept or reject or counter to that proposal on the same shared infrastructure, as opposed to having disparate systems that they agree and they talk and they go to their own corners and then they do their own thing in their own systems. This provides the ability to everything happen in a distributed basis, sharing the same information and acting on information towards each other, eliminating the need of reconciliations and preventing fails from happening. I think that is at a basic level, without all the complexity of how the technology works, that is how DLT can bring efficiency to all these processes front to back.
So if I understand correctly, it's not about a feature replacement. It's not about, we're going to swap out your database and this database and have one database. It's really about collapse of the multiple features to a much more unified platform. Is that right?
It is basically creating a very cohesive workflow and a standard workflow between the counterparties that is anchored by the shared information and activity that could be accessed by every party at the same time. So it is the ability for counterparties to know what the other counterparty knows, right? With the right permissions, right? But if we enter in the same transaction, I know for certain that your side of the transaction is the opposite to mine, that the number of shares is the same, I'm buying, you're selling, the price is set. The ability to be certain that you have the opposite side of my transaction, as opposed to finding out later towards the end of the day that we didn't have the same terms of the transaction. That is one of the key pieces that the technology can provide.
And is this a fair definition of the Repo platform that you are launching, or are there other parts to it?
Correct. So our Repo platform leverages those two features, if you want. The creation of a single source of truth of available or digitized collateral on the platform, and the smart contracts that had been entered in that transaction to manage the ownership of that collateral. And then the ability to create this multi-party workflow, this mutualized workflow, where one party can actually change the transaction, update it, make change to it, and then the counterparty can accept those, reject those, knowing that there is not going to be any discrepancies because you can see exactly what is happening on the platform.
So a little bit about the words, and I'm curious to how you think about it and what they mean. So there are words like DLT, distributed ledger technology. How is that different from blockchain? How is that different from digital assets? How is that different from decentralized networks or crypto assets? Words matter. So can you draw some of the distinctions that underlie these different words?
Yeah, so I would say that distributed ledger, it is a simplified or stripped down version of a blockchain, right? The blockchain has different type, more complex type of consensus, right? You have proof of work, proof of stake. In a DLT environment, which is permissioned institutional deployment of distributed ledger, all those features of consensus, proof of work, proof of stake are basically toned down because you are on a permissioned environment. And that is the way that we are thinking about distributed ledger technology at the early stages. Obviously, in the future, you never know how it's going to happen and how it's going to evolve. But given the risk-averse nature of the industry and the regulation around it, a permission environment around DLT, it is what has to take for the technology to be adopted. So in our world, the distributed ledger technology, it is basically creating a distributed environment where people can actually interact with each other, sharing at the single source of truth of information. That is the distinction that we apply between DLT and blockchain. As it relates to digital assets, there's various forms of digital assets in the way we think about it. We think about it from the more basic of a digital representation of the securities. Basically, you need to represent physical securities or existing securities onto a platform to make sure that you can transact on them. Then you go into further along the lines of tokens, which is you creating tokens digitally that has some links to existing securities. And then the third piece, which is more on the crypto side, which is the native securities that only exist on this digital platform. So we're focusing, as it relates to the institutional deployment of our platform, it is basically using the simplest way of a digital asset, which is just the representation of the securities on the platform to be able to transact on those securities.
How do you see the evolution of tokenization in institutional capital markets? What are the vectors that would underpin more adoption or that would accelerate adoption? Some of the early symptoms from 2018, 2019, whether it's the Australian Stock Exchange or in digital asset, whether it's some of the R3 projects, they kind of point to a real difficulty in tokenizing markets that are already experiencing high throughput and have lots and lots of integrated software stacks. At the same time, we know that for certainly the retail universe and now the brokerages that interact with the retail universe, the simplicity of digital assets and sort of their interoperability is very attractive and interesting. And so there's this operating contradiction of like the stuff that we have is very hard to pivot and there's not the economic reason to do so. And yet lots of people are, they're really trading abstractions, right? They're not touching any security. They're trading abstractions in some omnibus account on some intermediate system. So it's a pretty loaded question, but I guess if you were to look at the probable pathways of what tokenization and digital asset adoption could look like, what do you see ahead in the next decade?
I think we first need to think about capital markets industry, right? I think we first need to solve for the implementation of distributed ledger technology, solving for the processes, right? Because once you standardize the processes, as I said, you mutualize some of these workflows, you make them more efficient, then the ability to increase the complexity of the assets that those processes are going to be touching can increase, right? Right now, you think about the efforts around creating native securities, right? And there's been a lot of experiments in Europe, in Asia, highly successful. The issue is you need to have all the infrastructure and all the regulations to make sure that those become mainstream. And that takes time. What takes time is basically to create all the support network, all the connectivity to those platforms or those that are creating or issuing those tokens to basically connect to the current market system, which is very difficult to change because on a very risk-averse industry, highly regulated, it's very difficult to introduce change at a fast pace. So for me, I think the first thing to solve for is the processes and the workflows, making it digitally available already for them to be able to introduce more complex native securities, different sorts of tokens. But if you start with solving for the tokens or issuing tokens, but they don't have the right market support, they don't have the asset servicing requirements, they don't have the infrastructure required to be traded at scale, that is probably what they're going to fail, right? We need to solve for the processes first and the infrastructure first, and then you can start laying more complexity in terms of the asset classes. I think that is probably the way that is going to shape up and the way it's going to go.
Yeah, I think there's a set of ideas to explore about interoperability in the sense that at some point we likely would like to have markets interoperate and to have bridges between the different value chains and software stacks in the same way that, for example, when you go to a coffee shop, you can pay with cash or you can pay with a swipe of a credit or a debit card, which have electronic rails, or if you can pay with Google Pay or Apple Pay, which go through different payment processing rails, or potentially scanning a QR code with Alipay, which go on other payment rails. And all of these are systems that kind of underpin commerce and the particular transaction you're there to do. And it's sort of trivial to choose which one. And so there's, in my view, some future world out there where there is interoperability between the different crypto networks and blockchain rails and DLT rails. But it feels like there's certainly there are a lot of obstacles to get there. Is that a fair thought?
It is. And I was talking to somebody else about this topic a couple of weeks ago. And the interoperability has to be solved in pockets, right? If you want to impose some interoperability model, you feel like you're going to be boiling the ocean. So again, going back to the risk-averse nature of the industry, all the infrastructure required to support those type of transactions that you just mentioned, it is very difficult to have sweeping change and immediate change, right? So if we all in our different roles can solve for very specific pain points, very specific use cases that solve specific pain points with this technology, with the digitization technology, and then be prepared for the future interoperability, right? Making sure that we can connect to other systems, to other platforms. That is where progressively the compounding effects of all these initiatives that are thinking about interoperability the right way could take us to that interoperability model. But starting to impose an interoperability model from the beginning and set the rules of how it's going to work, it is going to be very difficult. So I think starting fairly small, something that is meaningful, but something that you can tackle, and then the compounding effect of it will actually take you where you want to go.
Yeah, that makes sense. I've got one last question about if we do go to this world where, let's just naively say, things are simpler, right? Where there is a digital truth about transactions and about the securities or assets or crypto cats to which the transactions apply. At what level in the industry do you think that will sit, right? So we've talked about there being the investment banks or the hedge funds that are doing the trading activity, and they've got innovation programs around blockchain. And we've talked about the DTCC and the various, Euroclear and so on. And they've got various distributed ledgers that they're trying to deploy. And then the folks doing the actual transaction computation today, like Broadridge, you're rolling out platforms that also mutualize a bunch of the stuff and kind of simplify it. What does the industry structure look like once the meal is cooked? What is the destination, you think?
That's a good way of putting it. How I see it, it is a consolidation or compression of front to back activities. So if everybody's solving for what they know and what they are focusing today because they see strong pain points that need to be solved, from the CSDs to Broadridge to actually the firms having their own innovation programs and solving for some of the pain points that they have, right? One of the results of this is going to be a collapsing of the front to back that I described before. All those processes that actually took various systems, various participants, hopefully they're going to be collapsed into a much shorter stack because we all going to be eliminating inefficiencies. We're all going to be eliminating processes that we shouldn't be doing because of the technologies that we are all implementing. So I think it's going to be a much simpler technology stack, and you won't see so many steps to solve for a transaction front to back, from the execution to the settlement. So we're all going to contribute to that compression front to back of the stack. How people are going to be playing in that more compressed stack is tough to say today. But if we're all focusing on solving for the right problems and removing inefficient tasks, removing inefficiencies, removing reconciliations, eliminating fails, and making life easier for all market participants, that is going to simplify all the complexities that I described at the beginning from front to back.
Fantastic. Thank you so much for taking the time and for geeking out with me about this really fascinating topic. And it has so much embedded complexity, but it's so important to the functioning of basically our economy and for determining the growth of companies and funding expansion and really catalyzing the real economy. And very few people really understand that there's this engine that powers it, and the engine is computational, and that there's deep work going on in making that engine better. So thank you again for opening that up for us, and appreciate all the time on the podcast.
Thank you very much for having me, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.